If you're a trader, you know the market is a battlefield. But you know what? The most important fight isn't against the charts or the news. It's the one happening right between your ears. Today, we're diving deep into the psychology that really makes or breaks a trader. And this quote right here, it just hits the nail on the head. It's from City Traders Imperium, and it perfectly sets the stage. See, this isn't about finding some magical indicator. It's all about mastering your own internal wiring. So who is this real enemy? Well, it's basically your brain's ancient survival software. We're talking about cognitive biases. These are mental shortcuts that were, fantastic for escaping a saber-toothed tiger, but they are absolutely disastrous when you're trying to navigate today's financial markets. Okay, so if we're going to win this internal battle, we first have to identify the enemy. So let's break down the 5 most dangerous biases that are silently sabotaging trading accounts everywhere. These are the mental traps that even the absolute smartest traders fall into if they're not careful. First up, we've got recency bias. This is basically your brain screaming that whatever just happened is what's most likely to happen next. So imagine this. You just nailed 3 winning trades in a row. You feel like a genius, right? Like you've finally cracked the code. That feeling, that's recency bias setting a trap for you. And here's exactly how that trap works. After that winning streak, you start getting cocky. You start over-leveraging, thinking you can't possibly lose. And on the flip side, after a few losses, you get gun-shy. You see a perfect setup, but you hesitate. In both cases, you're letting the last couple of trades totally dictate your actions, and you're completely ignoring your actual long-term strategy. All right, next is the heavyweight champion of trading biases, loss aversion. Get this. Research shows that the pain of losing $100 feels about twice as strong as the pleasure of gaining $100. That emotional imbalance, it leads to some of the most irrational decisions a trader can make. And this graph, this shows you exactly why. This is from prospect theory. Just look at how much steeper that curve is on the loss side compared to the gain side. That visual gap, that represents a huge emotional force that makes us do almost anything to avoid locking in a loss, even when it's the smartest thing to do. So how does this blow up your account? Well, it leads to the classic trader's sin, cutting your winners short and letting your losers run. You snatch a tiny profit because you're terrified it'll vanish, but you hold on to a losing trade, just hoping and praying it'll come back, turning a small, easy-to-manage loss into a catastrophic one. Okay, on to our third saboteur, confirmation bias. This is our natural instinct to build an echo chamber around ourselves. If you think a stock is a buy, your brain will literally go out and search for news, for charts, for opinions, anything that agrees with you, while conveniently making all the warning signs invisible. And this is where things get really dangerous, because it completely blinds you. You stop seeing the bearish signals, you only follow the Twitter gurus who share your bullish take, and pretty soon, you're not trading the market anymore. You're just trading your own opinion. You're building a position on a foundation of one-sided, flimsy evidence. And of course, what happens after you get a few wins thanks to your confirmation bias? You guessed it, overconfidence. This is the illusion that you've suddenly become a master of the universe. You start to think you're smarter than the market and that all those boring risk management rules, well, they're for other people, not for you. Let me tell you, overconfidence is the absolute fastest way to give back all your hard-earned gains and then some. You start jacking up your position sizes, making impulsive trades, and basically treating your risk plan like it's just a suggestion. But the market has a way of humbling everyone, and overconfidence just guarantees that humbling will be very, very painful. And finally, we have anchoring bias. This is the sunk cost fallacy in action. You're stuck in a losing trade, but you've already invested so much time watching it, so much emotional energy willing it to work, that you just can't bring yourself to cut it loose. You've anchored your decision-making to your original entry price, not to what the market is telling you right now. This bias makes you try to fight a freight train. You keep telling yourself, oh, it has to turn around soon. You might even start averaging down, throwing good money after bad. You become loyal to a bad decision. And in the market, loyalty to a losing position is a one-way ticket to a blown account. All right, so we've laid out all the problems. Now for the important part. What's the solution? And it's not some new fancy indicator. It's a fundamental shift in your mindset. It's about moving away from this desperate need to be right and toward learning how to simply think in bets. You know, as the author and poker champ Annie Duke points out, we have to realize that trading is a lot more like poker than it is like chess. In chess, all the information is right there on the board. The best move always wins. But poker and trading, you're dealing with incomplete information, luck is a factor, and here's the key. A really good, well-thought-out decision can still lose money. So how do you actually adopt this poker player's mindset? Well, it boils down to 3 key ideas. First, you have to separate the quality of your decision from the outcome. Judge your process, not whether one single trade won or lost. Second, you have to embrace uncertainty. Accept that you can't know everything. And third, you have to become a truth seeker. That means you actively go look for reasons why you might be wrong. It's the ultimate defense against confirmation bias. A new mindset is the foundation, for sure, but you need some practical tools to actually enforce it. So let's look at the simple, non-negotiable playbook that professionals use to protect themselves from their own worst enemy, which, as we know, is their own mind. It all starts with this one number, 1%. This is the absolute, ironclad maximum amount of capital a pro will risk on any single trade. And this isn't a friendly suggestion. It's the law that prevents any one bad decision or just a string of bad luck from taking them out of the game entirely. And this table right here, it shows you the pure math behind why that discipline is so powerful. With a positive risk-to-reward ratio, you don't even have to be right most of the time to make money. Just look at that bottom row. You can be wrong more often than you're right, a 40% win rate, but if your winners are 3 times bigger than your losers, you end up highly profitable. It's just math. There's no magic to it. So these are your non-negotiables. A predefined stop loss, so you know your exit before you even get in. It takes all the emotion out of it. Proper position sizing, which is your #1 defense, calculated based on that stop loss. And a trading journal. This is where you track everything, your trades, your emotions, your mistakes, so you can find and fix the patterns caused by your own biases. So, when you put this all together, what does it really mean? It means mastering the game of trading has very little to do with predicting the future. It's about mastering a repeatable, disciplined process. So here it is. This is your path forward. Number 1, awareness. Start looking for these 5 biases in your own trading. Be honest with yourself. Number 2, mindset. Make that shift from needing certainty to thinking in probabilities. And number 3, process. Execute a strict risk management plan on every single trade. No excuses, no exceptions. Because make no mistake about it, the market is a relentless psychological testing ground. It is designed to find and exploit every single bias, every weakness, and every emotional flaw you possess. The only question is, will you be ready for it?